Okay, so this is the part 2 of the chapter number 10, mortgage-backed sector of the bond market. In this video, we will talk about mortgage pass-through securities in detail. First of all, let's recall from our previous chapters. I believe that was, I think, chapter 2 or 3, when we defined these mortgage pass-through securities. So a mortgage pass-through security is a security created when one or more holders of mortgage form a collection, which we call a pool of mortgages, and sell shares or participation certificates in the pool. So they basically create a kind of bonds from that pool. So that pool is a security and underlying a security, and the securities they issue or the basically the securitized securities. So a pool may consist of several thousand or only a few mortgages. When mortgage is included in a pool of mortgages that is used as a collateral for mortgage pass-through security, the mortgage is said to be securitized. So how we securitize mortgage? We include it a pool and we issue securities against that pool. Remember, we also discussed some cash flow characteristics of the pass-through security. Let's again recall. The cash flow of mortgage pass-through security depends on cash flow of underlying pool of mortgages. Right? As we explained in the previous section, that cash flow consists of monthly mortgage payments representing interest and scheduled payment of principal and any prepayments. Right? So the scheduled payment of the principal, the payment of the interest, and any prepayments. Prepayments are made to security holders each month, right? Okay. The payments are made to security holders each month. However, neither the amount nor the timing of cash flow from the pool of mortgage is identical to the cash flow passed through to investors. So the amount and time are not identical to the pool as of the securities. The monthly cash flow for pass-through is less than the monthly cash flow for underlying pool of mortgages by an amount equal to we just discussed servicing and other fees. The other fees are those charged by the issuer or guarantor for pass-through for guaranteeing the issue. The coupon rate on pass-through is called the pass-through rate. The pass-through rate is less than the mortgage rate on underlying pool of mortgages by an amount equal to servicing and mortgaging and guaranteeing fees, right? So just to make sure that you get it. So the mortgage rate is higher, pass-through rate is lower by the amount of the servicing and guarantee fee. The pass-through rate, we refer it as a pass-through rate. The timing of the cash flow is also different. The monthly mortgage payment is due from each mortgage on the first day of each month, but there is a delay in passing through the corresponding monthly payment to the security holders. The length of the delay varies by the type of pass-through security. Not all mortgages that are included in a pool of mortgage are securitized have the same mortgage rate and the same maturity. So it's not necessary that all the securities are identical, right? So they can be different securities. A weighted average coupon rate or WACC. So WACC is weighted average coupon rate is found by weighting the mortgage rate of each mortgage loan in a pool by percentage of mortgage outstanding related to the outstanding amount of all the mortgages in the pool. In the same way, when a weighted average maturity of the mortgage is found by weighting the remaining number of months to maturity for each mortgage loan in the pool by the amount of outstanding mortgage balance. So we calculate weighted average coupon rate and weighted average maturity, right? Okay, let's see this example that how we do it. Let's so again, I have created this Excel sheet for you. Let's go to this Excel sheet and understand how this is done. Okay, so here is the Excel sheet. So let's talk about this. So let's suppose that our underlying pool has these 5 mortgage loans 1, 2, 3, 4, and 5. This is their individual outstanding balance, and this is the total. This is the mortgage rate, and this is the months remaining until maturity, right? So how we calculate the WAM and WAC and WAM, right? First of all, what we have to do is calculate weights for each of these mortgages. How to calculate weights? Just simply dividing the corresponding outstanding balance with the total outstanding balance of the pool, right? So just drag this down. So what we did is we okay, let me fix this cell again. Okay, okay, so I have fixed this cell. Now if I drag it, okay, and this total again should be 1, because obviously we have divided it by same amount. Okay, so first weighted average cost. So the weighted average cost is simply the multiplication of this weight and the corresponding cost, right? So this is our weighted average cost. And again, when we drag this here, and if we add them, we will get this weighted average cost. We can convert these numbers into the what we call the percentage, right? Let me do this as well. Right? So the weighted average cost is 7.28, which is same as if we have just calculated the average, right? Okay. Same way, we can calculate the weighted average maturity, and the weighted average maturity will be again similar. This number of months multiplied by weight in the pool, right? Again, break this down, and if we add them, we will get the weighted average maturity. So it's 278.71 days, which we, so days cannot be bifurcated, so we will count days as a whole. So it's at 279 days and 728 month. WAC is 7.28% and WAM is 279 days. I hope this is clear. This is pretty simple concept. Let's go back to our word file. Okay, so we just discussed the concept of weighted average cost and weighted average maturity. Okay, let's now discuss the various different types of pass-through securities, right? So there are various different types of pass-through securities. Mainly, in the United States, the 3 major types of pass-through securities are guaranteed by agencies created by Congress, and these agencies are very famous agencies. The Government National Mortgage Association, which they refer as GNME, the Federal Home Loan Mortgage Corporation, which is referred as Freddie Mac, and the Federal National Mortgage Association, which is referred to as Fannie Mae. Those agencies are government federal agency, right? While the Freddie Mac and Fannie Mae are commonly referred to as agencies of the U.S. government, both are corporate instrumentalities of the U.S. government. What we mean is that GNME, that they are government sponsored enterprises, and therefore their guarantee does not carry the full faith and credit of the U.S. government. In contrast, GNME is a part of Department of Housing and Urban Development, which is referred to the DHUD, and its guarantee carries the full faith of the U.S. government. The pass-through securities issued by the Fannie Mae and Freddie Mac are called conventional pass-through security. We refer them as agency pass-through securities. In order for a loan to be included in a pool of loan backing an agency security, be conforming mortgage, it must meet specified underwriting standards. So, loan to be included in a pool for these agency to be considered by these agencies need to meet some basic minimum criteria. The standard third, fourth, the maximum size of the loan documentation requirement, and maximum loan to value ratio, and whether or not insurance is required. So these are the few criteria. We will discuss them in, I think, in some point in our videos. If a loan satisfies the underwriting standards for inclusion as collateral for an agency mortgage-backed security, it is referred to as conforming mortgage. Otherwise, it's referred to as non-conforming. So the non-conforming mortgages used as a collateral for mortgage pass-through securities are privately issued. So it does not mean that non-conforming loans cannot be part of the pool. They can be, but they then are handled by the private issues, and then they are called non-agency mortgage pass-through securities and issued by thrift, commercial banks, and private conduits. Trading and settlement procedure. So the agency pass-through securities are identified by a pool of prefix and pool number provided by agency. The prefix indicates the type of the pass-through. There are specific rules established by Bond Market Association for trading and settlement of mortgage-backed securities. Many trades occurs while a pool is still specified, and therefore no pool information is known at the time of the trade. This kind of trade is called TBA, to be announced trade, in which the underlying pool of the mortgages is not known. The two parties agreed on the agency type, agency program, coupon rate, and face value, the price and settlement day, and then they communicate the pool accordingly. The quotation of the price is same as we used to quote the bonds. So the pass-through prices are quoted in this like 94.05 means 94 and 5/30 seconds of the par value, or 94.15625 of the par value. The price that the buyer pays to the seller is agreed upon sale price plus accrued interest. Remember, we discussed the concept of accrued interest in our, I think, chapter number 8, 7 or 8. Given the par value, the dollar price, excluding accrued interest, is affected by the amount of the pool mortgage balance outstanding, right? So a pool factor 90 means that 90% of the mortgage balance is outstanding. The pool factor is reported by agency each month. The dollar price paid for the principal is price times the par value times the pool factor, right? So the dollar price paid for just the principal is the price times par value times the factor. Okay, let's go to the measurement of the prepayment rate and discuss few more details. Okay. So measuring prepayment rate, it's important to specify and talk about the prepayment rate, right? So the prepayment is any payment toward the repayment of the principal that is in excess of the scheduled principal payment. In describing prepayments, the market participants refer to the prepayment rate and prepayment speed. There are 3 points to keep in mind in this discussion. First, we will look at how the actual and historical prepayment rate of a mortgage pool is calculated, right? So in this chapter, we will look at the calculation of historical and actual prepayment rate calculation. Second, we will also see later how in projecting the cash flow of a mortgage pool, the investor uses the same prepayment measures to project prepayments given a prepayment rate. Then the third point is that we are just describing the mechanics of calculating prepayment measure. The difficult task of projecting prepayment is not discussed here and is not part of our course. So remember this thing, right? So this is very important for you guys. Okay. So single monthly mortality rate, giving the amount of prepayment for a month and the amount that was available to prepay that month, a monthly prepayment rate can be calculated, right? It's simple, right? So how much you can prepay, it's the how much there is an outstanding balance, right? And how much prepayment you made, we can calculate this percentage. This is referred to as single monthly mortality rate, right? What? Single monthly mortality rate. So this is basically prepayment in the month T divided by beginning of the month balance for the month T minus scheduled principal payment in the month C. So we cannot consider this scheduled monthly principal payment of month T because it was already due for payment. So we exclude this from the beginning balance, and then we divide prepayment in month T with the amount outstanding, and we can calculate this single monthly mortality rate, right? Investors can use the formula to calculate SSM or given assumed SSM, and investor will use it to project the prepayment for a month. The prepayment for a month will then be used to determine cash flow of the mortgage pool for the month. So let's talk about some example. Let's assume that beginning mortgage balance is, let's say, uh, some amount which is let me write it here. So the beginning balance is some amount 358 million 326 and 766. The amount of scheduled payment which was due in this month was 297 825. So scheduled payment was, let me add some space here, is 297,825. And the prepayment we made is 1 million 841,000 and 347, right? So we can put these values in this formula. So let me just copy this formula here and put the actual values. So the actual values are 358, 326, 766. The okay, sorry, this is the balance outstanding, right? This is not the prepayment. The prepayment is 1,841,347, and the scheduled payments for this month is was the amount which is equal to 297,825, right? And if you solve this, you will get an answer of 0.5143%. So this is single monthly mortality rate for your difference, right? And you can rearrange this formula. If you have the SMM, you can rearrange the formula to calculate the prepayment in a month, which will be prepayment month will be equal to SMM multiplied by beginning mortgage balance for the month minus scheduled monthly payment, right? Okay. Then we have conditional prepayment rate. So the conditional prepayment rate is annualized SMM is called the simple conditional prepayment rate, right? So this is the monthly rate. If we annualize it, we will get the conditional rate. So let's see how to calculate this conditional rate. So I have just copied this formula. So we have this rate now, which is 0.005 143. So if you solve again this, you will get an answer of 0.06 or 6%. So the conditional prepayment rate, or the what we call annualized prepayment rate for this particular mortgage is 6%. Given the CPR, the corresponding SMM can be computed simply, right, from by rearranging this formula. And I think there is no need to explain this to you guys, right? Okay. Okay. So then the third thing we have is we refer is as PSA prepayment benchmark. PSA is basically the Public Security Association benchmark, and it is expressed as the monthly series of CPRs. The PSA benchmark assumes that the prepayment rates are low for newly originated mortgages, and then will speed up as mortgage become seasoned. Seasoned means as mortgage become old, right? Okay. So the PCA is basically assumes the following prepayment rate for 30-year mortgages. A CPR of 0.02 for first month, increased by 0.02% per year per month for the next 30 months until it reaches 6%, and 6% CPR for the remaining of the months. So if T is less than 30, then CPR is 6% multiplied by T by 30. And if T is equal to or greater than T, then it's 6%. So remember, this is CPR. This is not SMM. We have to first convert CPR into SMM and then use that SMM in our calculation. It's important to the CPR and corresponding SMM applied to mortgage pool based on the number of months since originations, right? So it will be applied to the pool of the mortgage on the basis of number of months. Let's again take an example and illustrate this with how a PCA CPR will work. So let's assume that if a mortgage pool has a loan that were originally 30 years mortgage loan, and a WAM is currently 357 months. So 3 months already passed. This means that the mortgage pool is seasoned 3 months. So in determining prepayment for the next month, the CPR and SMM that are applicable are those for month 4. Slower or faster CPR will result in so slower or faster speeds are then referred to as some percentage of PSA. For example, 50 PCA means 1/2 of the CPR of the PSA prepayment benchmark, and 150 PSA means 1.5 times of the PCR of the PSA benchmark, and 300 PSA means that the 3 times the CPR. So the prepayment rate of 0 means that no prepayment are assumed. While there are no prepayment of 0 PCA, there are scheduled prepayments, right? Okay, so let's look at the how this again works. So I have again embedded this Excel sheet. Let's go to the our Excel. But before going to the Excel sheet, this is very important to understand that illustration of monthly cash. In order to value pass through given PCA assumption, we must construct the monthly cash flow. That how much will be the monthly cash flow, the estimated, forecasted, or predicted monthly cash flow, right? Okay. So let's assume this is in our example for the pass through. The underlying mortgage for this hypothetical pass-through are assumed to be fixed rate, level payment, fully amortized mortgage with a weighted average open rate of 8.21. It will be assumed that the pass-through rate is 7.5% with a weighted average maturity of 357 months. Now let's go to the Excel sheet and explain to you that what is going on. Okay, so here is this example of a pass through in the Excel sheet. This is given in exhibit 3 of the book on page number 268. Now I will be explaining all of these calculations to you. So this is let's go by one. First column is the months from now. So how many months until the maturity of this pass-through securities. The second column is basically a months season. How many months since this pass-through is issued, right? So we assume it's since the 3 months. So it's the 4th month now. Column 3 gives us the outstanding balance. So the starting balance we assume is 400 million. Is I have already told you that this is a 400 million pool. So securities issued are 400 million, right? So we assume 400 million, and this beginning balance will come from this after deducting this scheduled payment and any prepayments. I will explain to you how all these are calculated in a bit. Column 4 shows the SMA, right? Single monthly mortality rate. Remember, given the assumption of the PSA, we can calculate the SMA, right? So the PSA assumption for this is that it's 100 PSA. Prepayment rate will be as per the 100 PSA. So which means that in each month, so I have included a single formula for whole of the life. I'm explaining it to you, right? So if remember we said until month 30. So if seasoned months is below 30, this value will be true, right? Which is 1 minus, remember the formula for SMM, how to calculate SMM from the CPR, right? So it will be 1 minus 0.002 into B2. Now B2 is number of months, right? So 0.002 multiplied by number of months, whole power 1 by 12, right? Whole power 1 by 12, and you will get this SMM, right? Remember the SMM formula. I'm using the same SMM formula here, right? So we discussed the CPR formula. From that CPR formula, we can calculate the SMM formula. You can find out that SMM formula in on page number 265 in equation 3, right? It's pretty straightforward. So if it's less than 30, this is how we define the SMM. But if it's more than 30, we define SMM just 6%, right? 6% power 1 by 2, right? Okay. Okay, and we enter it, right? So what I did is I just read this formula all through. So after 30 months, there will be a constant PSA, but before 30, it's a variable PSA. And at reaching 30, it already becomes equal to that of a PSA, right? Okay, so I hope this SMM thing is clear. Now the mortgage payment. The mortgage payment is basically changing every month. So although the payment of underlying mortgages is same, but the payment made to the investors is changing each month. And how it is determined is simply again how we discussed earlier. So it is each month it is determined based on the outstanding balance. What we do is in each month we divide this outstanding balance with this annuity factor. So how this annuity factors comes in is 1 plus, so 1 minus 1 plus rate. We know the underlying pool has a rate of 8.125%. Because it's annual, we divide it by 12 raised to power negative minus 361, because 4 months cost minus B2 whole divided by interest rate divided by 12. So this is simply the annuity formula. And what we do is we calculate this annuity formula. Using this annuity formula, we calculate mortgage payment each month, right? So each month there is a different mortgage payment for the pass-through securities, right? Okay. Column F. Column F reports the net interest, which is simply 7.5% times the outstanding balance at that time divided by 12, right? There is no need to explain it. Again, I dragged this formula. This is a scheduled payment. Scheduled payment is simply the mortgage payment minus the net interest. So the mortgage payment minus the net interest, but not this net interest. The mortgage payment minus 8.125. Remember the average mortgage rate for the underlying pool is 8.125. So the balance minus mortgage rate into C212, right? C2 divided by 12, which is the mortgage payment. Sorry, outstanding balance divided by 12. So we calculate this schedule payment. Now the prepayment again is simply the based on this schedule payment based on the formula we already discussed, and that is the, remember we discussed the formula for SMM, and that formula for SMM said that SMM can be calculated by dividing the prepayment for that month with beginning mortgage balance minus scheduled payment. But if we know the SMM, we will multiply the SMM with beginning balance minus the scheduled payment for that month. This will give us prepayment for that particular month, and that prepayment can be calculated pretty easily, right? The total principal will be scheduled principal plus prepayment, and the total cash flow will be scheduled principal, prepayment, and net interest, or the total principal plus net interest, right? So just I added them, right? So this is how we have calculated this, right? So I have briefly or not briefly in detail explained what each of these columns do, right? So what I did then is break this down, right? And if you see by the end of this pass-through security, there will be a zero balance outstanding, right? So the cash flow is the principal payment is 501 199, and here is 501 199, right? So this is how to calculate the cash flows of a pass-through security, assuming 100 PCA. But what we can do is we can also calculate this by assuming in other PCA benchmark. Let me show you that in other PCA benchmark. I have that in again in that word file. Okay, so let's look at what will happen if we assume 165 PSA rather than 100 PSA. So if we assume 165 PSA, the only change in this will be here in SMM calculation and here in this formula. Previously, I was just multiplying 0.002 with the number of months the mortgage has seasoned. Now I am multiplying it with 1.65 as well. So previously it was understood that it is 100 PSA, so 1 is multiplied. Now because it's 165, so I'm multiplying it with 1.65. Similarly, here after the 30 months, 30 and after the 30 months, I multiply 0.06 or the 6% also with 1.65. What this do is this results in a quicker prepayment, right? So there is a now quick prepayments. The prepayment amount is higher, right? All the other things will remain same. Why I am explaining this 1.65 PSA? Because we will be using this in one of our future calculations, right? I hope all of you are clear about this. If you have any question, post it on our LNS and I will surely gladly answer those. Okay, so this is for the 100 PSA calculation. This Excel sheet is for 165 PSA calculation, right? Now let's talk about the average life. For mortgage-backed security, we know that principal payments, scheduled payments, and prepayments are made over the life of the security. While mortgage-backed has a legal maturity, which is the date when the last scheduled payment is due. The legal maturity does not tell us about the characteristics of the security as it pertains to the interest rate risk. Remember, when we refer to the maturity of a 5-year bond, we typically know that principal that how risky it is, that how much is interest rate risk. Longer the maturity of the bond, more interest rate is there, right? Remember the basic rule. But for the mortgage-backed securities, it's difficult, right? Because borrower can prepay at any time. For example, it's incorrect to think a 30-year corporate bond in a market-backed security with a 30-year legal maturity with the same coupon rate as being equivalent in terms of interest rate risk. Of course, the duration can be computed for both corporate and mortgage-backed security, and we will discuss this. But instead of duration, another measure widely used by market participants is weighted average life, or simply average life, and it is calculated as T times projected principal received at time T divided by 12 into total principal, right? So this calculation can be made pretty easily. Let me again show you how to calculate this in one of our Excel sheets, right? Why not calculate it here in this Excel sheet, right? Okay, let me again go to that Excel sheet. Okay, so I can calculate the average life of the security, right? So remember the formula. The formula for the average life is time, which is the number of month we are in, right? Big T is this is the number of months we are in, and we multiply this with project principal received at time T. So the total principal we receive at time T, better to again put it in this, right? Divided by 12 times, again, let's put it into bracket, 12 times 400 million, right? last one. Let happen. Okay. Let me open it again because it ended. It ended. Okay. So let me calculate it again. So the T multiplied by principal payment divided by 12 multiplied by 400 million. Right? Okay, let me see what I'm doing wrong. I think this comma should not be here. Okay, so it was commas. Then just drag it until the last month. And then simply calculate the sum. So the average life for this is 119.21 months. So let's round it off to 119 months. So this is how to calculate the average life. So what's the formula? Formula is that first multiply the total principal with the month we are in, then divide it with 12 times the total outstanding balance. Okay, sorry. What I am doing is making some mistake. No, it's a short total principal, right? And so that's it. So we got okay, 119, and in terms of years, this will be 9.93 years, right? But I think it's not like this. Okay, let me just correct it. So this is the total outstanding balance, which is this one. And I think this should change each month. So if it should change each month, then we should get a higher value rather than a, no, this is all right. Okay, right? So this is 9 point, almost 10 years, right? Okay, I hope this is clear. Okay, again, let me go to our Word file and then discuss again. Okay, so we discuss average life. Now, what are the factors which affect the prepayment behavior? We will quickly discuss few of them. Main is prevailing mortgage rate. So the higher the lower the prevailing mortgage rate, there are more chances that the borrower will refinance the mortgage and will prepay, right? The spread between the prepaid mortgage rate in the market, prevailing mortgage rate in the market, and the rate paid by the homeowner affects the incentive to refinance. Moreover, the path to mortgage rate since the loan was originated affects prepayments through a phenomena referred to as refinance burnout. So it's really important that what is the prepayment rate. Then there is housing turnover. The level of mortgage rates also get affected by housing turnover to the extent that the lower rate increases the affordability of homes. So if the houses are lower, people can afford homes and they can buy homes. However, even without lower interest, there is a normal amount of housing turnover. This is attributed to economic growth. The link is as follows. A growing economy is thus in a rise in personal income and in opportunities for worker migration. This increases family mobility and as a result increases housing turnover. Then there is a characteristics of the underlying residential mortgages. So these can be how much season it is, where it is located, and these kind of characteristics. Then finally, we have a contraction risk and extension risk. This we will discuss in future as well, that what we mean by construction and extension risk. Let me sum it up that what we mean by contraction and extraction risk. To understand the significance, this is related to the significance of prepayment risk. Suppose an investor buys a 9% coupon pass-through security at a time when mortgage rates are 10%. So you bought a 9% pass-through security, mortgage rates are 10%. Let's consider that what will happen to prepayment if mortgage rates decline to say 6%. There will be two adverse consequences as an investor. First, basic property of the fixed income security is that the price of an option-free bond will rise. But in the case of pass-through security, the rise in the price will not be as large as that of an option-free bond, because a fall in interest rate will give the borrower an incentive to repay the loan and refinance the debt at a lower rate, right? So it's a fixed income security, its price will increase, but it also gives borrower an incentive to refinance. This results in the same adverse consequences faced by holders of a callable bond. As in the case of those instruments, the upside price potential of a pass-through security is compressed because of the prepayment. And we discussed this as a negative convexity characteristics in chapter number 7. The second adverse consequence is that the cash flow must be reinvested at a lower rate. So you had a prepayment, you got cash flows, now you have to invest them at a lower rate. Basically, the faster prepayments resulting from a decline in interest rate cause the pass-through to shorten in terms of timing of its cash flows. Another way of saying is that shortening results in a decline in average life. Consequently, the two adverse consequences from a decline in interest rate for a pass-through security are referred to as contraction risk, right? Opposite to this is the extension risk. Now, what's the extension risk? It's, let's say that what happens if mortgage, so you have a you bought a 9% pass through when the rates are 10%. What will happen if interest rates go to 15%? The price of pass through, like the price of a bond, will decline. But again, it will decline more because the higher rates will tend to slow down the rate of prepayment, in effect increasing the amount invested at the coupon rate, which is lower than the market rate. Prepayments will slow down because homeowners will not refinance or partially prepay their mortgages when mortgages rates are higher than the contract rate. Of course, this is just the time when investors want prepayments to step up so that they can reinvest the prepayments at a higher market interest rate. So that's a negative. Basically, the slower prepayments associated with the rise in interest rates that cause these adverse consequences are due to pass-through lengthening in terms of the timing of the cash flow. Another way of saying that is lengthening results in an increase in the average life. Consequently, the adverse consequence from a rise in interest rates is referred to as extension risk. We will come back to these both. Keep these two definitions in mind. We will come back to these two from time to time and to link it with different concepts in our future videos. That's all for the pass-through securities. Thank you.